let's start. This is Nwajiugo Chisom Wisdom. This is Falcon. Welcome guys. Thank you for watching this video. So let's move on. Today, my name is hello everybody. My name is Nwajiugo Chisom Wisdom. I've said that before, and I welcome you guys to this Forex masterclass where I'll be teaching you how to trade the Forex market using the ICT Inner Circle Trader methodology. In this course, you are going to learn how smart money moves the market and how you can trade like professional institutes. So let's move on. So introduction to Forex and trading. So I use Forex for example here. I'm trying to use Forex. You can add Nasdaq, not Nasdaq, indices or other assets. So, but let's start from Forex, then move on. On this module 1, we talk about understanding the Forex market, liquidity pools, and market making, and who is ICT, philosophy and concept, the truth about inner circle, smart money, and retail traders, the key ICT term, PDRS, Fair liquidity pool, setting up MetaTrader 5, and trading view for charting. So let's move on. So what is trading? What is forex trading? Understanding the market. Forex or forex exchange market is where currencies are traded globally. It is the largest financial market in the world with over $6 trillion traded daily. So as traders, we buy one currency while selling another, aiming towards make profit from movement in price. So like example is where we trade is a decentralized movement. So let's move on. So let's talk about the history behind the forex market. The modern forex market was established in 1970s after the collapse of the Bretton Woods Agreement. Since then, it has evolved into a decentralized. What do I mean by this word decentralized? Decentralized talks about operating like power is not concentrated on one place. So it's a decentralized marketplace, like a decentralized what marketplace. So Forex plays a vital role in international trade, investment, and global economic stability. So let's move on. Let's look at section 3. Key Forex term you must know. So there are key Forex term everybody must know. First of all is PEEP. PEEP talks about the smallest amount of movement in price. So the smallest amount of movement in price is known as what? PEEP. So let's move on. There's what we call lot size. So lot size is the amount you are willing to go into a market with, the size of a trade position. So you can go into a market with $10, $1. Others can go with $100,000, $10,000, depending. So in this lot size, we have what they call standard lots, minimum lot, macro, and nano. So standard lot size is known as $100,000 units. We have mini lot size known as 10,000. We have macro lot size known as 1,000, and nano lot size known as what $100 downwards. Let's move on. There's what we call leverage. Leverage talks about borrowed money from brokers that allows you to control large trade with small capital. It allows you to control large trade with what? Small capital. Leverage basically allows you to control huge amount of money that is not big, basically in your account. This amount of money are not basically in your account, but you control it with small amount of money. Let's move on. That's what we call margin, the amount required to open a trade. The minimum amount of money your broker requires from you to put in your account for you to be able to control any financial unit of currency you want to control or deposit. Do you understand? So, but let's talk about this leverage a little bit. Is the ratio of amount capital in a transaction to the required security deposit. So the security deposit there they are talking about is known as what? Margin. Margin. Leverage is the amount you want to control. Margin is the amount deposited in your account. Leverage is the amount you want to control. So there's difference between the amount you want to control and the amount that is in your account. Margin is the amount in your account, while leverage is the amount you want to control. The amount you want to control is known as what? Leverage. Let's move on. Section 4. Let's talk about major currency pairs. There's what they call currency pairs. The most traded currency pairs are called the major pairs. Example: Euro, USD, GPD, USD, JPY. We have USD card. We have USD card. We have um Australian USD, but these are the major pairs. We have minor pairs, we have major pairs. So the markets, let's talk about these currency pairs for a moment before we move on. There's what we call the base currency and the quote currency. The base currency and the what? Quote currency. So in this Euro USD, the base currency there is euro, the first one, while the quote currency is the second one. Do you understand? So the base currency is the first one, while the quote is the second one. So the base currency is the reference element for the exchange rate of the currency pair. It always has a value of 1. So is the reference element for the exchange rate of the currency pair. So the reference what element? Look at it. The reference element here is known as what? Euro. This euro is the first one is known as what? The base currency, while the second one is known as what? Counter or quote currency. Do you understand? So let's move on. So let's talk about the time the market operates. Market operates 24 hours and 5 days. But if it's commodities operates 24 hours 7. You can trade even on Saturdays and Sundays. But forex market, you only trade on from Monday to Friday. You don't trade on Saturdays and Sunday. They use it for their holiday. They call it weekend. So the market operates 24-hour 5, but the best trading times are during active section. So look at the best trading times. You have what they call London section. Sorry, I made a mistake. GMT. GMT. The time that's supposed to be here is New York time. New York. New New York time. So 12 a.m. to 12 p.m. New York time. So check that in your own country and know which time is 12 a.m. to 12 p.m. New York time is in your country. So 12 a.m. to 12 p.m. New York time is known as London section. While 12 p.m. to 6 p.m. is known as New York section, and Asian section is 6 p.m. to 12 a.m. New York time. You must get it. Is New York what? New York. Let me write it well before someone said New York time. New York time. New York what times? It's not your local time. New York time. Why is it New York time? Because which country is the world power? Is it not America? So the global time we use is mainly America, then London. You can add London to the global time, but the main one we normally use is known as what? New York time. The market mainly. So during those periods, I would tell you when the market normally opens, the time which the market normally opens. Let's move on. That's what they call how forex broker works. You guys have heard me say brokers. Brokers are like the middleman between the buyers and the sellers. So there are two types of brokers. They are the middleman between what the buyers and the sellers. There are two types of broker. We have ECN brokers who gives direct access to market price with real time access. So these are people you deposit your money. These are the people you deposit the amount required to open a minimum to open and maintain a trade. So where will you deposit money? You deposit this money to your brokers who gives you access to the market real time what price. So the brokers gives you access. They are the doorway to the market. So for you to enter the market, you pay a fee. That fee is, let's call it, any amount you want to open the market to place a trade. So but the people that gives you access, like before you the broker gives you access to the marketplace, but before you participate in the market you must come with money now. So but who are the people that gives you access? The people that gives you access is known as what? The brokers, the ECN brokers. These guys don't control price. They are the weak man, but they are powerful. So they are brokers. So another kind of brokers is known as market makers who create their own price and might trade against you. So these guys are the people that normally push up the price. You see the price go up, the price go down. You see the candles. These are the guys that normally does that thing. They normally do that thing. They are known as what? Market makers who create their own price. They create their own price. They are called the market makers. So knowing your broker types helps you understand what we call spreads and execution speed and transparency. So let's talk about spread for a moment. So you wanted to buy a pack of yogurt for $100, but there's someone selling for $90. The space is known as what? Spread. Let me show you something. Let me show you something. Wait. Yeah, I think I have it here on my seat. Let me show you. So wait, just give me a minute. Let me find it. So let me find it. So, but let's keep talking. You understand? So the market makers are the people that create the move price. They are the people that moves price. They move price. They what? Move price. So what is a spread? A spread is the difference between the bid and the ask price. If a spread is the difference between the bid and the ask price. Bid, ask, ask. So what is bid? Bid is the price at which your broker is willing to buy the base currency. You guys know what's base currency? Let me go back. Let me show you. Oh god, my mouse. Oh god. Is he here? Okay. Let me show. Hey, look at so the the bid is the price at which your brokers is willing to buy the base currency. So the price they are willing to buy the base currency, this one is known as what? The bid. Why the price they are willing to sell the base currency, and the base currency is known as what? Ask. So what is spread? Spread is the difference between the bid price and the ask price. So imagine I wanted to buy this yogurt for $100 and someone is willing to sell it for let's say $200. So the space between 100 and 200 is the what bid. Before we close, there's what they call types of market orders. The the types of market orders. Market order. What is market order? It helps you execute your the price which your broker. Do you understand? It helps to execute on the price which your broker provided. So it helps you to execute on the. It helps you to execute on the. Oh God, wait. Permit me. On the. It helps you to execute on the price which your broker provided. So if your broker is willing to buy this at $100, so you must buy it at $100. That's the work of market order. So let's go. In market order, we have types of order. We have pending order, buy limit, and sell limit. So limit order is known as below the current price. So buying below the current price. Let me see if I can find a drawing tool like animation. Let me see if I can find a drawing tool. So I will explain this thing very well for you guys. I didn't see anyone here, but I will make sure I get one next time. Wait. Let's see. There's no one here. There's no. Oh, it's not here. Okay, let's leave it. But let's move on. So, by limit, let's imagine like let's bring something like. Okay, let's forget it. Okay, let's imagine that this let's use 2 or percent. Let's use this dollar sign. Let's use this dollar. This is not the sign. Let's use dollar sign. So this is the price. Now, for you to buy this dollar sign here, for you to use this limit order for the dollar sign, you have to wait for the price to come here. You want this dollar sign to come here, then you can to come below. Let's say 1 and 2. Okay, 2 and 3. So let's arrange it very well. And 3. So you want the price, you set your limit price at 3. So when the market comes to 3, do you understand? Then it puts you in. Then it starts going up. It's known as limit price. Vice versa. So you wait for the market. The current price is this dollar. Is 1 is the current price. You want the market to come down to 3 before the price put you in is below the current price. Where is the current price? The current price is at $10. Let's say $10, $20, and $30. So you want the price to come down to $30 before you can what buy. Do you understand? But let's reverse it very well. 3. Let's use 3, 2, yeah, 1. So you want the price to come down. You can't buy at the high price. You want the market to come down to $10, which is the low price. Then you can buy there. It's called buy limit. Placing your trade here. So putting the market, like, you now set your buy limit like this. Let's say this is your buy limit. This is your buy limit. This is your buy limit. So the market will come down like this, and tap it, then starts going up. It's known as what? Buy limit. Is below the current price. What's the current price of the market? The current price of the market is $30. So you want the market to come down to $10. Then you buy it from this $10. For you, when the market goes up, you make 2%. You are making, if you bought something at $10 and sold it for $3, you made profits. Now you made what? $20 extra. They call it what? Buy limit. But what is buy stop? Another types of order. Buy stop is when the market is at $10. This is the market is at $10. Your buy stop is this one. Is you set your buy stop at $20. It's above the current price. So the market will take you in. So what you'll be making from this market is $20. You bought it at $20 and sold it for $30. Do you understand? It took you in. The market took you in like this. But sell limit is below the market price. Below the market price. Buy limit is what? Above. Sell limit order is below the market price. Why why buy stop is above the market price. So limit is below the market price, while buy stop is above. Limit below, buy stop above. So let's write it here. Okay, let me add. Okay, let's write it here. This one is called stop. This one is called limit. This one is called, let's put $sign money. Let's put the so this one is what? Buy stop. Buy stop is above the market price. Buy limit is what? Below the market price. Let me use a diagram. Look at it here. This one is this one. Yeah. Why this one is this one? Do you understand? This is the current price. This is known as what? This one is known as the current price. They call this one what? The current price. The what? Price. So let's move on. There's what they call stop loss. Let me show you what is stop loss. 15 minutes. Let's say it's 15. Let's say $5. 5. Stop loss helps you to protect your money. Stop loss remain effective. Like, it helps you to protect your money. What do I mean? If the only thing you want to risk in this market is only $5, so you place your stop loss here. So when the market comes down to buy limit and then go hit your stop loss, so hitting your stop loss means it's taking you out of the market. Stop loss helps you to protect your money. It helps you to protect you. It's your friend. It's not your enemy. It helps you to protect what? Your money. That's why you need stop loss. Don't place a trade without a stop loss. Don't listen to those guys that used to say they place a trade without stop loss. Learn to place a trade with what? Stop loss till you advance. Do you understand? So demo talks about fake money. Trading with what? With trading with fake money. Fake money. Oh god, what do I write? Trading with fake money. So demo talks about trading with what? Fake fake. Is it this one? Did you guys get it? It is fake. Trading with fake money. That's what we call demo. So you trade with fake money. It helps you to learn the market. So these are things you must understand. Do you understand? So you must understand these things before you go into the market and then start placing a trade. You must understand this simple concept before what? Placing a trade. This helps you to place a trade. Do you understand? If you don't understand, please drop your question in in the comments section. Drop a question there and I will answer you very well in my next video. So make sure you drop your question if you find it confusing. So let's move on. In our next video, we'll talk about market structure and smart money concepts. This is where we start going into chart. What is candle? What is body? What is weak? What is this bearish and the bullish markets? You understand what is bearish and the bullish market, but let's explain it small. When you are buying, you are in a bullish market, but when you are selling, you are in what? A bearish market. But you will understand it in our next class. So in the next lesson, we go deep into market structure and smart money concept ICT method. Make sure you subscribe, stay focused, and let's build your trading journey step by step. Thank you for watching. This is Nwajiugo Chisom Wisdom. See you in our next video. Be safe. Love you guys. Remember to like and subscribe to my channel. Thank you.